What is a fixed index annuity is the topic of today's video. Fixed index annuities have been exploding in popularity recently, with each of the last 3 years recording record amounts being invested into these investment vehicles. In 2024 alone, $125.5 billion was invested into fixed index annuities. And it's no surprise to me of the rise in popularity of fixed index annuity coincides with a record number of Americans reaching age 65 in 2024, with the pace expected to continue through 2027. More Americans are retiring today than at any other point in our nation's history, and many of them are incorporating fixed indexed annuities into their retirement plans, as you heard from the numbers before. Why is this the case? Is it a good idea to incorporate a fixed index annuity into your retirement plan? What does a fixed index annuity do? What are the benefits? What are the downsides? These are all things that we'll be discussing, so stay tuned. My name is Spencer Ford, CEO and Wealth Advisor at Conservative Financial Solutions. I'm also a certified financial planner professional, and let's get into today's video. As I mentioned, fixed index annuities are exploding in popularity, and many pre-retirees and retirees are incorporating them into their financial plan. But what is a fixed index annuity? A fixed index annuity is an investment product issued by an insurance company. It's designed to protect your original deposit when the market goes down, combined with an opportunity for growth when the market is up. So how does that work? Well, when you put money on deposit with an insurance company, they take that money and they invest it into their corporate account. That account produces interest. The insurance company uses a portion of that interest to purchase options on various indexes. If that index goes up in value, interest is credited back to you as the holder of the policy, the fixed index annuity. If the index goes down in value, the option that was purchased expires and your principal remains the same. The insurance company isn't out any of their principal because they're just using the interest generated from their investments to purchase those options. Therefore, your principal is protected as well. That's a simple example. You can get much more into the weeds than that, but that's just a basic overview of how a fixed index annuity is designed to operate. Typically, when you invest in a fixed index annuity, you are subject to a cap or participation rate. Let's say the index that your fixed index annuity is tracking is the S&P 500, for example. This is a very popular option, but there are many different indexes out there. We'll just use the S&P 500 in our example because it's a very well-known index. If you are subject to a cap, you have the potential to earn up to that cap over the crediting period. The crediting period is the period of time you are tracking the index before interest is credited. A popular period is 1 year, but you also have 2, 3, or even 6-year crediting period options. We'll stick to the 1 year for our example. Let's say you're tracking the S&P 500 for 1 year and your cap is 10%. If over the course of that year, the S&P 500 is up 8%, you would be credited with 8% to your contract. If the S&P 500 was up 15%, you would be credited with 10% because your cap is 10%. However, if the S&P 500 was down, whether that be 5, 10, 20, or even 50%, you would simply get credited with a 0% interest rate that year and your principal would be protected. You also have participation rates. Let's say your participation rate is 50% and you are still tracking the S&P 500 over 1 year. If the S&P 500 is up 8%, you'd be credited with 4%, which is 50% of the index performance, 50% participation. What if the S&P 500 has a home run year and it's up 30%? You would be credited with 15%, which is higher than that 10% cap we talked about in our previous example. So it can be a good idea to blend cap strategies with participation strategies. Now, let's put some dollars to it. Let's assume you put $100,000 into a fixed index annuity and you're tracking the S&P 500 for a year. If the S&P 500 is up 8% and your cap is 10%, you'd be credited with $8,000 or 8%. Your $100,000 would be worth $108,000. One of the potential benefits of a fixed index annuity, aside from the downside protection, is an annual reset. Each year, on your contract anniversary date, which is the date that your policy started, your contract resets. Here's an example. Let's say you're $100,000 over the course of the first year. On your contract anniversary date, your policy did credit that 8% or $8,000. Now your contract is worth $108,000. Now let's say that the next year is a bad year for the market, for the index, and it's down 20%. Your $108,000 would remain $108,000. So after each year, your value is locked in. Think of it like a set of steps. The first year, you go up the first step. Your $100,000 goes to $108,000. The next year, the index declines and you stay on the same step. Let's say the following year, the index is going up again and it's up another 8%. Well, now your $108,000 is now worth over $116,000. Plus, you didn't have to make up for the losses the year in which the index had a poor performance and was negative. Another benefit to a fixed index annuity can be no fees taken directly from your account value. The insurance company is making money from investing your money in their corporate account. Therefore, a fee doesn't need to be deducted from your account value in order for them to be successful. Some fixed index annuities do have fees if you add different policy attachments known as riders. We won't be getting into that in today's video, so for now we're just illustrating a fixed index annuity that's designed to grow as an account balance for you to use, which you can take withdrawals from. What are the downsides? All this sounds great, Spencer. What's the catch? Well, many fixed index annuities have 5, 7, 10, or even 12-year terms. It's a long-term investment vehicle. When you purchase a fixed index annuity, you are making a commitment. Generally, you can access a portion of your account balance each year for withdrawals if you need them. Many fixed index annuities offer 10% penalty-free withdrawals each year. So you do have access to your money. If you need to take out more than that, more than the 10%, you'll be hit with a surrender charge. The reason for this is the insurance company is depending on enough of that money remaining in the account for a long enough period of time for them to make money on the policy. Some insurance companies don't break even until several years into the policy. Rates can change on policies. Some companies guarantee rates for the entire length of the policy, but other companies don't. And you want to keep that in mind. You don't want to start off with a 10% cap just to see it go down to 5% because of the term and the constraints on how much you can take out each year. You want to make sure you don't put too much money into a fixed index annuity if you decide it's a good vehicle for you. We like fixed index annuities for a portion of the money. Many of our families have invested a portion of their money in a fixed index annuity. It offers protection from the downside, opportunity on the upside, and a safe place to pull income from when the market is down. It's helped prevent making losses even worse during those times when the market is in a period of decline. In our experience, this has afforded families the opportunity to take the income when they need it in the form of withdrawals from the fixed index annuity while letting their market money ride for a longer period of time. Because it isn't about trying to time the market, it's about time in the market. If you want to explore fixed index annuities further, feel free to give us a call and speak to one of our advisors. Again, I'm Spencer Ford. If you found this video helpful, please hit subscribe and we'll see you in the next one.